Hopefully everyone can hear me. We have had a few little technical issues, as I said, and your usual presenter, or the presenter we had lined up for today, Tim from ShareCafe, has had some technical issues. So we apologise for that, but we'll get the show on the road. So we do have in excess of 150 shareholders on the line, and I appreciate all the support that you guys have given to this new initiative as we move into this interesting time. A bit of housekeeping, you will have seen there is a Q&A button at the bottom of the screen. That gives you the opportunity to put forward any questions you may have of the presenters, and we'll get to those as their presentation completes. You are all muted and are unable to turn on your audio or visual, so that is the best function for you to submit your questions and go through from there. So let's get right into it, and we do start with an exceptional presenter, Andrew Smith, who's the head of small and microcap companies at Perennial. Andrew has been a lead manager on the Microcap Opportunities Fund since its inception in February 2017, and has responsibility for the coordination and quality of the research effort across Perennial values. So, Andrew, without further ado, over to you.
Thank you very much, David. And perhaps if I start on the next slide, just to put the recent crisis in some context. If we were sitting in talking about this in the middle of March, which we actually did with a bunch of our clients, the sell-off was pretty severe at that point. If you look at the lows there, which I've taken the peak from the 20th of February down till it was about mid-March. At one point, the Australian microcap index was down close to 53%, the small cap index down close to 41%. And as you know, the US and the large cap index down to mid 30%. That's a huge decline by historical standards. And if you look at the speed of the decline, and I've compared it to the 1987 crash, which had a similar decline, but that took 2 months. Obviously, this took a matter of weeks. So we were dealing with quite a severe sell-off. The VIX, which is a measure of volatility, you can see spiked up to GFC levels. So we, in the middle of this crisis, as a team, we sat down and regularly assessed the risks that we saw, but also importantly, the opportunities, because such a large sell-off does create opportunities. If you flick to the next slide, one opportunity we saw was Australia was getting treated just the same as US stocks. In fact, if you look at the Australian microcap numbers, which I went through before, down 50% or more, that was missing what we thought was a pretty crucial difference here in Australia. It's great to see it playing out in the last few days in terms of the low number of cases. Now, why were we comfortable that Australia would come out better than other countries around the world? There's a couple of reasons. The population density, which you can see here, is very low. So it's much harder for the virus to spread. So that's a natural advantage. We're obviously an island state, so we can close our borders pretty effectively, which, as you know, we did. One other thing that might have been missed by a lot was our lab testing capability is very high. We had some insights into this. We're a big shareholder in Genetic Signatures, which actually provides flu-based testing, put out their quarterly result today, and they've been able to sell COVID tests both here and in Europe. They've got 3 new customers as a result of this crisis. But the insights we had through owning that stock for 6 months was that Australia's got great testing infrastructure in the normal course, and testing seems to be one of the key ways to get the virus under control and enable the economies to open up. So at the middle of March, we made the decision that we were going to pivot our portfolio towards the opportunities we saw in microcaps that were oversold, and also with a domestic focus. So with that in mind, we moved to a pretty fully invested position by the end of the month. If you flick to the next slide, the other reason that gave us some comfort around the middle of March was the huge amount of monetary and fiscal response. So compare this to the GFC, which I was obviously managing money through for the small cap fund. The speed of the response was much quicker, both from a monetary sense, but more importantly, I think from a fiscal sense, because it is a fiscal solution that was needed. And in Australia, I think we've done an excellent job. JobKeeper, for example, I've had 3 conversations with companies today that have all accessed the JobKeeper payment. It's enabling them to keep their staff. It's reducing the economic impact from the virus. So we are in a recession triggered by the virus, but in terms of it is shaping up, in our view, in Australia to be more of a V-shape when the market was pricing something much more severe than that in the middle of March. So just jumping to the next slide. To summarise the sort of thought process we put around the sell-off was it started off with panic, and probably the lows ended with panic. What we were seeing each day, we were working, my dealer and my team all working remotely, but it's easy as if I managed to work remotely. We didn't miss a beat. But the feedback we were getting from brokers was there was some panic selling out there. There was forced selling, so people with leverage in their portfolios were forced sellers. And that's what whenever we see that dislocation from fundamentals, we think it's good opportunities for investors. So hence why we moved to fully invested. But we were conscious of what are the next few stages of the recovery. The first stage, and this is drawing from our experience in previous sell-offs like the GFC, was there'd be a flight to quality. So everything fell about the same magnitude during that first period. And then the market starts to sift through the winners and the losers. And that's often where the best opportunities with the lowest risk can be made, because you're buying a company that might have 30 or 40 million of net cash and might be in healthcare, for example, like Genetic Signatures. That's exactly the situation they were in, and they actually had a test for COVID. Now, they were sold off initially as much as, say, a retail company. Now, clearly that makes no sense. So that's a great way to pivot the portfolio and reduce the risk, but you're also getting quite a nice bit of upside. So we've seen that start to play out. The good news in microcaps, and I'll share some data later, is it's a very big universe. So it could be some of the companies presenting today. There's thousands of companies to choose from for investors. The ASX microcap index is very rich universe, and there's still a lot of this sifting of between the winners and losers to come, and that's a great area for investors to be looking for good returns. So we've seen a bit of this, sort of particularly amongst the bigger stocks, this flight to quality, sifting between the winners and the losers. The next phase we saw coming was the recap trades. So this is where a company is forced to raise equity to fix their balance sheet. That can be a great source of entry for investors at a discounted price. So early on, we saw discounts as big as 50%. Something like a Kathmandu was a stock we actually bought for the small cap fund at a 50% discount. A great entry point into a business that post the capital raising was de-risked in terms of a balance sheet. They had 12 months of runway before they would start running out of cash again, assuming a very, very weak environment. So that's a great way to re-enter stocks at a discount. So we thought that was going to be the next phase. And I would say this has probably happened quicker than I anticipated. It has been hectic. There's been recapitalization trades, sort of 2 or 3 a day. So we've been very active in the microcap fund. I think we've added 6 new names to the microcap fund on the back of equity raisings. Most of these companies we have known over the last 2 years, and we just see this as a good entry point. Also, there's clearly going to be some companies that don't make it. We had one company in March that went into a trading halt, and we wrote that company down to zero. We don't want to be throwing good money after bad, so we wrote that company down to zero in our portfolio to focus on the higher quality opportunities we had. And then the last part of the phase will be, an economic recovery and a more broader broader stock market recovery. I still feel like the full economic recovery is obviously a long way away. We still haven't seen peak unemployment, but already there's encouraging signs of the Australian and I would say the New Zealand economy too starting to open up. So that's encouraging. Moving on to the next slide, just to put in context, performance. This is the performance of our microcap fund net of fees. So March was a tough month. We tend to be close to fully invested at most times. So our microcap fund was down 20%. Obviously a good result in the context of how bad the index was at 22, but also those microcap numbers I put up before, which at one point was down 50%. So we fell less than the market, but pleasingly coming out of April, that pivot of the portfolio that I mentioned played out really nicely. This is a couple of days old, but we're up about 20%. I haven't adjusted any of the other numbers, just that April month to date is just a snapshot. Clearly the 1 year number and others would have moved as well. But there's been quite a snapback already. I do think now that changes the type of investments people should be looking at. You need to be, after the bounce we've had, be much more discerning because there is definitely some stocks that are going to be impacted from the COVID crisis. And we just want to make sure that they haven't rebound too far. So it's very much a stock picker's market, I'd say now. And the beauty of that in the microcap context, if we go to the next slide, is it's a very, very big market. So we have a cutoff here of 20 mil market cap. So that's 850 stocks outside the index. And often these are very poorly covered by brokers. And we often find that's the best source of excess returns, opportunities that are poorly researched. As an individual investor or as a fund, you can do your own research and get a good edge on the market. And you can see there that the average microcap's got 0.8 analysts on it. So clearly a lot don't have any analysts. Compare that to the top 100 where there's 10 or 11 analysts covering the stock. Very hard to get an edge there. We do also invest in private companies in both our microcap fund, and we've got a dedicated private business. That gives us great insights into what's going on as well. And we've been having just as many meetings with private companies as we have with public, because often you get much more granular detail and honesty, I would say, in the private sector. So that's really helpful for us stock picking on that access to the private sector. So if we go to the next slide, how did we assess the opportunities? We started off, we did this at the beginning of March as a team. I plotted every stock we held in the portfolio on this matrix. And the matrix is pretty simple. It's strong balance sheet to weak balance sheet, weak demand to strong demand. And that demand's in the context of a COVID lockdown. So on the left-hand side, we had retail stocks, energy stocks, things like that are clearly going to be impacted. And then stocks that would do well, healthcare, gold, telecommunications, for example. So we plotted every stock. And when we did start, we did have some companies that were in that bottom left quadrant, which you now see is empty, but it wasn't that way at the beginning or even mid-March. So we had to work really hard to exit those positions and pivot our cash towards the better performing stocks. That panic that I mentioned did mean that we had some healthcare names. You can see that's 9% of the fund in healthcare. We had a couple of stocks that at one point were down 60%, and they're in the healthcare space, which should be very defensive. And that just shows the level of panic that was out there. Similarly, gold stocks were sold down quite aggressively initially, just as people sought liquidity. And that's despite the Aussie dollar gold price being better. So gold prices higher, stock prices should have followed, but they didn't in that early March period because of the level of panic. We have seen that normalise. You will see there we track director buying. So if a stock's down 40 or 50%, they've just reported there's no restriction on directors buying stock at that point. Late February, early March, there's no restrictions. They've just reported their results. So if we're not seeing director buying, it's actually a cause for concern for us. But pleasingly, directors in the companies that we track spent $3 million. So that was a good, encouraging sign. And you see, we're not taking balance sheet risk because microcaps, they can fail. Banks do walk away. So we have 70% of our portfolio is for companies that have no debt. At this stage, we have no travel or media or property. I think property is one of the sectors that's going to be really impacted for the medium term, office and retail. So we're quite cautious there. Travel, we probably will start thinking about domestic travel. There's a few names in small caps we've started looking at. But energy, we think there's been too much demand destruction. Never say never, but at that stage, that's how the portfolio is positioned. And our initial exposure in retail is to online only. We see some trends really being shifted forward. And Marley Spoon was actually one of the companies we bought in mid-March. We were able to take advantage of a forced seller, someone who needed to sell. We built a really nice position, and amazingly, the stock has tripled from our entry price in mid-March. That's been a great investment for us. They reported yesterday, very strong quarter, and particularly a strong April, up over 100%. We think that's going to bring forward, and the management basically said to us their ambitions for revenue and for customer acquisition have been brought forward about 2 years by this crisis. Marley Spoon, for those of you who don't know, is an at-home meal delivery service. So clearly, a lot more people are becoming familiar with their service in the current climate. If we drill down even further on the next slide, obviously the best opportunities were the stocks that were in that far right-hand quadrant. So stocks that not only had strong balance sheet, but also were built to do better in this environment. So there's a couple of names to talk about there. And I would hasten at this point to refer you to this disclaimer at the end of the presentation. None of these is talked about recommendation. This is just Perennial's opinions on stocks. So please read the disclaimer. And I would also add that a lot of these stocks have performed well this month as the markets have caught up with their fundamentals. But some pretty obvious examples, we're all sitting at home using a home broadband, and Tim was saying before he had 3 kids all on his broadband. So we've seen people upgrade their broadband plans, and we've got investments in both Unity Wireless and Superloop, which have great exposure to that. At one point, both those stocks were down 50%, which clearly made no sense given the improving demand environment. Pleasingly, the market has got their head around the improving fundamentals there. So telecommunications is an obvious way to play. Gold, I've mentioned. Another one which probably was under the radar a fair bit, Limeade, which actually reported their quarterly this morning. Quite encouraging quarter. 32 million US of cash. And they're an employee engagement software. So big organisations use them to monitor and manage the well-being of their employees. So clearly, with a lot of staff being forced to work from home, Limeade's been able to use that to help sell their software, and they've seen quite nice customer growth. Online education is another one. Janison Education is a big holding in the Microcap fund, and they're seeing universities, including a customer out of Canada, actually found them via their website, and they're now doing online exams for that Canadian university. So we're seeing a rapid uptake of online trends. So really what we thought would happen in 3 years is probably happening in 6 months. So that's a key theme that we think still got a lot to play out through the listed market. So if you come across anywhere that's benefiting from an online switch, that's a good place to be in our view. Other sectors which we think are less cyclical, clean tech, that's a made up sector that we've made up here at Perennial. Anything that's giving environmental benefits, there's a lot of pressure both from investors and governments. And now with sanitation, for example, Aries Environmental's one of those placements that we participated in. I make sanitation equipment, again, just reported a nice quarter today. So that there's quite a nice selection of stocks in the microcap end in that sector, and I've put a few names there. Clearly, any company involved in COVID testing, we're doing well, and pleasingly, we've got 2 ways to play that. So genetic signatures, which I touched on before, GSS, again, came out with their quarterly today, and that's really fast forward. We funded them last year. Part of the $30 million on their balance sheet came from us, and that was to help their global expansion of their flu detection. COVID's just meant this has happened probably 18 months faster. They've now got 3 European clients and plus added 2 new ones in Australia. So really pleased with the progress there. And we had an IPO of Atomo this month, which is a blood-based detection technology. They provide the device. And so they've had some biotech companies from around the world put their COVID testing on their device. They've also got HIV testing, which is already approved, and the World Health Organization is a customer. So that's been a successful investment for us. Just moving to the next slide. We're always trying to think about the next sectors that might be interesting. We do feel it's a little early right now, but resources have been a massive underperformer for several years now. You've seen supply cut pretty dramatically in a lot of commodities. Demand's very weak right now, so it does feel a little early to be buying resources, but we're certainly doing the work and picking out the favourites. The co-portfolio manager with me, Sam Berridge, is based in Perth, so he's on the ground there, and he's poised, ready to put money to work in the resources space when we think the demand conditions have stabilised. So we're on the lookout for opportunities in resources. And finally, I would hasten, I've talked about a lot of stocks here, but on the next slide, you'll see we actually have quite a diverse portfolio. So at 65 stocks, we can go up to 70. And I think we'll probably get towards 70 in the next week or so with the opportunities we're seeing. That spreads our risk because microcap stocks do come with higher risk. So we encourage everyone to either invest via a fund or have a very diverse portfolio. And you'll see there that the valuation, the great news at the moment in microcaps is you can still get high growth companies. You can see we've got 36% growth on average over the next 3 years in the microcap fund. That's the average EPS forecast per annum. That's quite a bit ahead of market, and yet we're paying half the market PE, 6 times on FY22 earnings. And as I mentioned before, 70% of our portfolio has no debt. So we're feeling really comfortable about the portfolio. And that's the great silver lining about a crisis, which don't get me wrong, there's going to be a real economic impact, and I've got lots of friends who have lost their jobs or are on reduced wages. So there is a real economic impact from this sell-off. But the silver lining is there's a heck of a lot of value out there in the microcap space if you go out there and look. The last slide is just to read the next slide there, just to show you again, we're not very concentrated. We do spread our portfolio across 65 stocks. And at the moment, that was our positioning at the end of March. So you can see the biggest percentage of the portfolio is 4.4%. And pleasingly, 3 of those companies reported in the last 2 days their quarterlies, Marley Spoon, Limeade and Genetic Signatures, and all tracking nicely. Probably close on the next slide with the disclaimer. Just encourage you all to read that. And happy, David, to take any questions.
Thanks, Andrew. Thanks for the presentation and a great presentation. And I think something that the viewers of this webinar will take a lot from. Clearly, a well thought out investment strategy. There was one question that I will pull out before we run to the next speaker, which is, given there's a number of decent sized private placements and a number of them are probably at the larger end, is there an opportunity for a fund like yours to sort of trade in and out on the opportunity, or do you sort of stay away from the NABs and the bigger placements as a trading opportunity?
Yeah, that's a great question. We've got a number of funds. I look after the small cap fund, which only restrictions that it can't be top 50. So we can look at anything outside the top 50 in that fund. The microcap fund, which we've spoken about today, is below 500 million. So the placement would have to be in a stock below 500 million. In both the small cap fund and the microcap fund, we do look at opportunistic trades, more likely to happen in the small cap fund because you've got some liquidity. In the microcap fund, we tend to look at placements as a way of getting access to a stock at a really good entry point. I think it's dangerous in microcaps if you try and, with a fund of our size, if you try and trade, just have trading positions in the placement, liquidity might not be there, but completely agree. There's been some excellent opportunities in our small cap fund. I think we've probably traded 4 placements for 15 to 20% this month. So yes, and I think being very active, the volatility in my mind is going to continue. We've had such a sharp recovery. It wouldn't surprise me if we sort of saw knife pattern from here. So being very active and taking advantage of that volatility with trading is not a bad idea as well, we think.
So a couple of questions I'll sort of try and roll into a few. Firstly, size of the fund. Secondly, do you take into account ESG issues when looking at stock selection? And there was a question, is the fund listed?
So the fund's not listed. It's currently about 170 million under management. We closed the fund last August when it got to 200. Clearly with the market sell-off, we opened it back up again. So it is open at the moment. And we will close it to new investors again at 200 million. With ESG, we've actually got a dedicated ESG analyst. She does an excellent job for us. She helps us not only with voting, but also we put a score against every stock on an ESG basis. And we try and deliver a portfolio that's got better ESG characteristics than the market. Now we have a dedicated fund, which actually is listed. There's an ESG small cap fund called impq.asx, which is our ESG version of the small cap fund. So that is a list. That's our only listed fund. So that's if you want, a really big premium to ESG. And then we've got our small cap fund, which is a bit of a premium. Microcaps, we find the data and the quality, the board just doesn't have the depth that you would need to get really high ESG scores. So that's the sort of cascading ESG focus across our funds, if that makes sense.
It does.
I think it's a really important issue though, and it's going to start impacting the cost of capital for companies. So clean tech, the reason why that's such a big part of our portfolio is we see that strong thematic lasting for several years, if not decades.
Great. Well, on that note, Andrew, thanks for a great presentation and enjoy the rest of your day. You've added a great deal to the webinar and I can't thank you enough. And you'd be hearing, you'd be hearing a loud applause from the 200 plus people who are watching online, but sadly it'll be a virtual applause, but thank you very much.
No worries, David. Thank you. And thank you, Tim, for the invite. See you later.
Great. I'd now like to introduce Brad Underwood. Brad is the Managing Director of Galileo Mining, stock code GAL. and they are a Mark Creasy-backed nickel, copper and cobalt explorer specialising in the Norseman and Fraser Range areas of Western Australia. So without further ado, we'd like to introduce Brad to the panel.
Great, thanks David, and thanks everyone for tuning in today. It's rather a brief presentation, so I'll get through it pretty quickly, and if you've got any questions, please feel free to ask them at the end. The next slide is just a standard disclaimer, and then this slide goes into why we believe Galileo is a great company for investors interested in exploration stocks listed on the ASX. And the first point there is really fundamental to where we are. We have just completed a $5 million raise, and in this market it was very well subscribed, and we now have 9.5 million in cash. What we are focused on is looking for Nova-style high-value nickel targets in the Fraser Range belt. We know that if we are lucky enough to make one of these discoveries, that we should see a large amount of value appreciation on the market. All of our assets are in the Tier 1 mining jurisdiction of Western Australia. We have a strategic focus on drilling programs to create value. We've also got another project at Norseman, and Mark Creasy is the founder of the company and the major shareholder with a 26% holding. Just a quick look at our corporate snapshot. Post the placement, we now have 143 million shares on issue. It's quite a tight capital structure. I mentioned Mark Creasy has 26%, but we also have IGO on there for 8.9%, and they own and operate the Nova mine in the Fraser Range. So it's very good to see them support our recent placement. They are highly active in that area, and they are seeking new discoveries by themselves and supporting those other companies out there who are doing a good job in the Fraser Range. When we listed the company 2 years ago, we took a strategic approach to both the commodities we're interested in and the districts where we wanted to be active. So nickel and cobalt are the metals that we're most focused on, and we are exclusively based in Western Australia. Within and around the areas that we work, east of Kalgoorlie and east of Norseman, there are numerous operating mines and world-class infrastructure. We have road, rail, and the Port of Esperance to the south. What this means is that if we are lucky enough to make a discovery, then the expected capital development costs are much reduced, which flows through to a higher valuation on any new resources that we uncover. The Fraser Range is a great place to be exploring. There are two deposits, one which has been mined already at the Nova mine, and then there's the Creasy-owned Silverknight deposit. I previously worked for Mark Creasy and have been working in the Fraser Range since 2010. So it's an area that we know well and we understand the prospectivity. More recently, Galileo Mining, another ASX listed company, has had success at their Mawson prospect with a number of really significant massive sulfide intercepts, and their share price has appreciated very quickly on the back of those. So we are currently working along strike from Galileo Mining, and we have an 8,000 metre drilling program underway. At Norseman, we have a 25 million tonne JORC resource already, and that's a cobalt and nickel resource. And we have ongoing nickel, copper and cobalt exploration in that area as well. Fraser Range is really a great place to be exploring. It's such an undeveloped province, but it is quickly moving ahead. At IGO, at the Nova mine, they've got a 14 million tonne resource. Silverknight, that's Mark Creasy's deposit, around 4 million tonnes. Galileo Mining have recently made their announcements on their massive sulfide intercepts, and we've seen similar grades there as have been discovered at Nova. At Galileo, we have 600 square kilometres of prospective ground in two areas, and that goes back to the strategic approach that we took when we wanted to be close to existing infrastructure. So our Lantern prospect is just 15 kilometres from the railway. Our Empire Rose prospect is just 10 kilometres from the highway. The Nova mine is around 80 kilometres away from our Lantern prospect. This slide demonstrates why we think there is so much potential in the Fraser Range. The best analogy to these types of deposits globally is in Canada. And in Canada, we can see there are three nickel mining areas around the margins of a large geological body called the Superior Province. Similar in Western Australia, where we have the Archean Craton and the Fraser Range on the margin of that. If we see on the next slide, of the Canadian nickel belts, the Thomson nickel belt is that which is closest to the Fraser Range. In the Thomson belt, there are over 146 million tonnes of non-resources. There are over 10 deposits and mines active in that area. In the Fraser Range at the moment, we have 2 drilled out deposits, one which is operating at Nova, and a total of just 18 million tonnes. So it's just over 10% of the total non-resource that occurs in the Thomson nickel belt and very similar geology in Canada. The big difference between the Fraser Range and the Thomson belt is the time and effort that has gone into exploration and mining. In the Fraser Range, Nova was discovered in 2012. We've had less than 8 years of exploration and mining. Compare that with the Thomson belt, where we've had over 50 years of exploration and mining, and that gives you a credible reason as to the number of deposits that have been found in that area. We expect over the next few years that there will be more discoveries in the Fraser Range. And if the belt holds a similar number of resources to that which we see in other areas, such as the Thomson belt, we'd expect to see many more millions of tonnes of resources uncovered in this area. The Lantern prospect is in the northern part of the Fraser Range, very close to the railway, and a long strike from Legend Mining's Mawson prospect. On this map, it's called Area D. That was the name before they made the large discovery. We are completely surrounded by other explorers that are very active in the area. IGO are looking to spend over $50 million in the Fraser Range. We have the Creasy Group that is still exploring there. We have Legend Mining, and then we have ourselves. The first ever drilling we undertook at the Lantern prospect, the first ever RC drilling program, we discovered nickel copper sulfide mineralization. And on the next slide, we will see that we've built up a couple of targets in this area. We have the Lantern North, which is a large EM target, and we have the Lantern South, which is the sulfide target where we've intersected the mineralization. One of the key points about this slide is the similarities between our geology and that at Nova. The large intrusion at the Lantern prospect is around 2 by 2.3 kilometers. At Nova, it's 2.4 by 1.2 kilometers. So the way that this geology works is there's a large body of rock around and within which are small pods of mineralization. So we've discovered a small amount of mineralization with the very limited drilling that we've undertaken. Just skip to the next slide. We'll see that what we did was reconnaissance air core drilling across the top of the intrusion. We found a sniff of geochemistry. We drilled beneath that and we immediately discovered sulfides. This is a disseminated sulfide occurrence, but what's important to understand is that we are seeing maximum values of nickel and copper around 0.7%. This is sulfide of about 10%. It's slightly technical, but to understand that if we were to see massive sulfide with a similar level of nickel and copper, the grades would be much, much higher. So our job now is to explore along strike and around where we have discovered the sulfide mineralization to look for those pockets that are higher grade and worth extracting. We have over 2 kilometers of untested strike, and that's the current focus of our drilling program. That's a slide there showing the untested strike length. All we've done so far is a couple of rounds of air core, 1 round of RC. We've determined that this prospect has a lot of significance to it. We're able to raise $5 million on the back of the results that we've generated today to allow us to continue with the drilling that we've got. Now that we've completed the placement, and remembering from the previous speaker that this is coming off the back of that coronavirus low, that we managed to get the $5 million in, which allows us a very aggressive expansion of the work we have planned. So we've immediately gone from a 4,000 meter air core drilling program up to 8,000 meters, with a number of other programs designed already to follow up from that. On the next slide, you'll see this is the core of our business. We are an exploration company. Most of our money goes into the ground. We've had 10 drilling programs since we listed 2 years ago. So we're very much focused on drilling as a way to create value. And for us, the more drilling programs we undertake, the more chance we have of success, and that's what we're aiming for. We also have the Empire Rose prospect, which is at the southern end of the belt. I'll just skip over these last few slides as we've run out of time. On the next slide is our Norseman project. We have a 25 million tonne resource already. It's focused around cobalt. The cobalt price has dropped over the past 12 to 18 months, but if we see a resurgence in that price based on increasing demand, then we'd expect to see this asset have a lot of value again. So similar to the beginning slide, just to go over the main points about our company, we are very well funded for a junior exploration company with 9.5 million in cash. The management and team at Galileo have been involved with discoveries before. It's what we do as part of our business. We're very highly leveraged to nickel and cobalt. The demand is increasing for those. It's forecast to increase over the next 5 years quite dramatically. The Fraser Range has a high potential for new nickel deposits, and that's what we're aiming to discover. Norseman, we have an existing resource, and most importantly, our drilling programs are underway, and we expect to see results flow over the next month, and we've got some more programs lined up to follow up on any results that we have as we look to make that next discovery in the Fraser Range. Thanks for listening, and if you have any questions, please email David.
Brad, thanks for your presentation. Very thorough, and as you say, a great part of the world to be in, well-funded and with significant investors and partners, potential partners on your register. So a compelling story. So Brad, thank you very much. If there are any questions, what we'll do is we'll submit them through and let them be answered on the ShareCafe website, which you can go to and see more information about these companies. So Brad, thank you very much.
Great, thanks very much.
I'd like to now introduce our next presenter, Glenn Smith, Managing Director of TALi Digital, stock code TD1. TALi Digital is an Australian medical technology company that has a clinically proven assessment tool and training tool to help with attention training and attention detection of detention issues in young children. So Glenn, over to you.
Thank you, David, and welcome all. Following on from David and moving to the first slide, we are a company that is built on evidence base, so medical research and scientific research that delivers our technology solutions to children with a core focus of attention, and our primary objective is to create happier kids. So moving on, we have been developing or on this pathway now for about 3 years. We have a platform technology, and that technology is made up of a set of proprietary algorithms that allow applications, similar applications that you can download from iTunes or Google Play stores, to deliver out evidence-based assessment and treatment in relation to attention issues in early childhood. It's patent protected, trademarks, we've clinically and scientifically validated what we've done, and our products are medical devices. So we've been through those regulatory hurdles, and we've proven that our digital technologies are akin to medical devices. We've got partnerships, and we'll talk a little bit more about Google as we go through this presentation. But I think primarily what we've done now is build a world-class team, and we're revenue ready. So we have products, and we'll talk about some of the opportunities, particularly in the Australian market, which were highlighted at the beginning of this session in relation to why Australia might be ahead of the game. Moving on. So we've made a key critical milestones over the last 6 months, and primarily they are around setting the foundations to allow the products to be actively marketed and sold in the domestic economy. But what we've also done here, particularly in April, is secured our place in the global market by receiving a US patent, which complements our Australian patent. We've got patent applications in other jurisdictions, but essentially gives us a core competitive advantage and a real freedom to operate as the first early childhood digital company on the planet to deliver assessment and training outcomes for inattention. And that's really critical, and we'll talk about that as we go through the slides. Next, please. So we have a world-class team in place, and I'll highlight these next two slides, but particularly led by Sue McLeeman, who is a very well-known, respected individual in the Australian global community, more than 30 years experience in this pharmaceutical medical technology area, complemented by the other board members, myself, who've been in and understand this company and this sector now for multi-year periods. Moving on. And now we've really secured some high quality people, and their primary objectives, particularly Pete, David and Lee, as you see here from their roles, is to really accelerate the rollout of our products, because we have built product and we're ready to roll out and ready to generate revenue. So we have built that really world-class global team, and their core focus, particularly in the coming period, is to roll this out domestically. Moving on. So why inattention? Well, you know, we tell everyone that there's a massive human impact here, and inattention actually does deserve our attention. So let's move on, I'll tell you why. So attention is actually, or inattention, issues around attention are the most commonly reported childhood issue. We know this from Medicare codes and other type of healthcare codes, where children are placed in the healthcare system or other areas, and these issues are reported. They're massive. So at a clinical level, there are 136 million children globally who have reported severe attention issues, so clinically reported severe attention issues. We know that 13% of children each year in Australia start school with attention problems. And we know that these attention problems laid in foundations of clinical diseases such as ADHD or autism spectrum disorder. And we know there are massive financial burdens attached to this. And an example is that in Australia, we have set up a national disability insurance scheme. And the biggest component of that scheme is autism spectrum disorder and the spend on the autism spectrum disorder. It's the single biggest spend in the national disability insurance scheme. Let's move on. So early detection is really key, because the real cost to an individual, an economy, a healthcare system, an education system is if all this is missed along the way, and then you end up with adults with these issues later in life. We know early detection is vital as well, because we can make a difference when the brain is most young and most plastic, and that's called neuroplasticity. And effectively, we have the capability and technologies to implement care for children early, in that early period of 3 to 8 years. That's when you can change the neural connections and pathways of a child. And we can do that through non-pharmaceutical digital interventions, and we'll start to talk about TALi now. Let's move on. But just to give you a little bit more context about inattention and how important attention is, this slide will allow you to go away and look at this in more detail. Attention is actually a really core component or foundation of a lot of these core issues globally. And we talk about, you know, intellectual disabilities, depressive disorders, we talk about Down syndrome, ADHD, and particularly autism spectrum disorder. Attention is a core component of that, and really identifying and then assisting or treating attention early on can avoid or can assist with some of these conditions. Let's move on. So we have built this company as global from day one. And that's because inattention and attention related issues are a global problem. We're a digital company with applications that can be put through channel partners and other organizations and stores that allow us to have a global market opportunity. Let's move on. Again, you know, we talk about the number of children. We spoke about this earlier, 136 million and 40,000 start school in Australia each year with attention issues. Let's keep moving. This is a massive growth area. Cognitive assessment and training was forecast, or was in 2016, a $2 billion opportunity. By 2021, at least an $8 billion. What we're seeing now in this new digital age is a massive explosion of that opportunity. And that's because in this sector, large corporates such as Google and other large corporates have moved into the health space and application space so that they can get a foothold in this area. We know there's a massive cost of attention, and that's why early investment brings the biggest returns. And here is just a graphical indication of the type of outcomes you can get if you address children early in life in relation to attention in particular. And that's why this investment in TALi is so important. We can access children early and set them on the pathway. And as we develop our platform technology, we'll layer over different applications, which will be tailored and personalized for those children as they move into later in life, teenage and adulthood life. So this starting in this early childhood is where we can help and capture those children early. Let's move on. So we're ready to scale and ready to sell. And I go back to comments earlier about Australia might be ahead of the game. And that's why we're squarely focused our core activity, particularly in Q2 and Q3 of this calendar year, on the rollout and early release in Australia and early revenue generation. And then as we go through this calendar year into next year, what we're doing is securing partnerships in international jurisdictions where we can co-market or other type of activities or channel partnerships where those companies of large scale will help us push out this technology and help us with our development of other applications as we go through the next few years. Let's move on. So TALi is delivered through digital devices and mainly iPads and tablets and Google Chromebooks as examples. We also have capability in Windows and smartphones as we move through this year. But effectively, it was designed to be used by children across the world because it's accessible and it's affordable. It's game-based. It can be used on iPads and tablets and other devices. And we can get reimbursements in certain jurisdictions for this technology because it's evidence-based and it's a regulated medical device. And that's what we've done in other jurisdictions. Key to what we're doing is partnerships. And this Google Education partnership is really significant for TALi. Effectively, 55% of all children in the US school system open a Google device every day and go into the Google Education environment and download applications in that environment to start their learning and education. We are now a certified partner in Google Education, and our applications will be delivered and rolled out into that Google environment as part of this business development partnership we have with TALi. And I think that will be the backbone of growth for us as we move through the coming months and years. Let's move on. So as I said, we're part of the solution because we're practical and we're an affordable tool. Let's keep moving. We make a real difference. We're based on 20 years of research and development of psychology and cognitive neuroscience, leading institutions in Australia, and now as we move overseas, leading institutions internationally are helping us continue that research and backing us. And we'll talk about that soon. Let's move on. So we're for kids. Again, I reiterate, we're early intervention, early childhood, specifically in that 3 to 8 years of range for what our TALi train or treatment intervention product is, around that 4, 5, and 6 for our assessment. So we identify children at risk, we can triage them and deliver them digital non-pharmaceutical interventions early and help them progress with their learning and attention outcomes. So our model is based around direct-to-consumer parents, a healthcare model where we target psychologists and other occupational therapists who deal with children with these type of issues, and primarily schools, where schools are at the front line, where they identify children early with inattention, and we can assess and then help those children with training and treatment pathways through our tool, TALi. What we do is produce personalised, in-depth reports that parents, healthcare providers and teachers can access, provides real-time analysis, individually tailored for each child, and gives recommendations to those carers or those teachers and healthcare professionals about what to do next. So this gives you an example of a child who might be assessed with TALi Detect. They're either on track in green, they're monitor in the middle, or they're prompted. So that's really on track, mid-level risk, high-level risk. And these high-level risks would obviously be provided more information to allow them to pass through into the TALi train pathway, along with those who monitor, so they may be borderline, and where TALi train may be of assistance for those children. But there will be a portion of the children who are on track, and they should continue on with their social and learning experience, but we can continue to assess them with TALi Detect every 6 months to see where they're ending up. TALi Train, as I said, is a treatment. It focuses on selective attention, sustained attention, and executive attention. These are core principles in this early developmental psychology area, and these are proven areas which we base our technology and science off. Let's keep moving. TALi Train is, as I said, another game-based application where we have selection, focus, control, and inhibition exercises. It's all really designed for fun, engaging, where children actually engage for 20 minutes a day, have a fun and inspiring experience, and don't know they're actually being delivered a therapeutic treatment. And that's the core advantage that we have. We, as I said, we've got clinical evidence, scientific evidence. We're a registered medical device. And I'll skip through this slide, but there's some key areas that I think you should go back and have a look here. That's particularly in relation to what the scientific evidence says around typically developing children. So those who have ADHD symptoms and how TALi Train can assist there. For those who already have a clinical condition like autism spectrum disorder, there's significant attention gains there. And with some really great early results for TALi Detect in school, in real life examples, where children are being assessed primarily and then moving through the pathway to get assistance. And we'll have more data coming out soon that will back up all this really successful early data. Our goal is to create happier children. We know this because we get quantitative and qualitative data back from parents and teachers. We know 93% of parents note improvements moving through. We know digital learning is here to stay. We've spoken about that. And so we're primed to really leverage off that because we're global from day one, digital. We can link into remote learning. Children engage with our tools because they're iPad-based and game environments, and they complement what we're doing in terms of learning outcomes. Continue through. We produce happier kids kits. I suggest everyone go to our website, download it. It's free. It's a really great kit for children and parents. We're rolling out above the line and digital marketing and advertising as we roll through this quarter that will raise awareness and recognition of TALi and attention as an issue and TALi products. And again, I thank you for your time. And this is, as we say, a noble investment that delivers happier kids. Appreciate your time.
Thanks, Glenn. A great presentation and a great insight into TALi Digital, stock code TD1, and the TALi product range, which, as you say, are partnered with significant groups and embedded with significant groups and are clinically proven. So certainly one to watch this year as revenue is clearly the focus of the company into the next financial year. So Glenn, well done.
Thanks again, David.
Great. Well, we do have some questions, but we will deal with those through the ShareCafe company page for TD1. So we'll deal with those later just to keep time moving. Our next presenter is Colin Locke, Executive Chairman of Krakatoa Resources, stock code KTA. So Colin, over to you.
Thanks, Tim, for the invitation. I'm going to be brief, and thank you, viewers, for tuning in. I'm here primarily to introduce you to this hidden gem in the form of Krakatoa, which arguably is an outstanding leverage opportunity. Now, this hidden gem may end up being hidden gold. I'm confident that I can offer subscribers here this outstanding leverage opportunity that will all culminate, hopefully, in the second half of this year in the form of a discovery that we're hell-bent on being able to deliver for our shareholders. Now, we've just recently, that's September last year, acquired the Belgravia project Now, this Belgravia project's exceptionally positioned, and shareholders of Krakatoa find themselves in a position by having and being part of the cheapest house in the most exclusive porphyry street in the world. Located 35 kilometres in the same belt and with the same geology as Australia's biggest and most lucrative gold mine, being Newcrest Cadia, and 65 kilometres to the north is the you'll see it there in the bluey green is Alkane's Boda discovery. It's a narrow belt, the Molong volcanic belt, comprising of approximately 100 kilometres, and it's quite narrow. And importantly, we're right next to Copper Hill. I'll explain a bit about that in the next upcoming slide. Corporately, we have only 218 million shares on issue. Last time I looked at the price, it was 3 cents, giving a market cap of approximately 6.6 million, with cash at approximately 1.1. Therefore, we have an EV of 5.5. Now, significantly and arguably, to get a clean shell these days, probably you're looking around about, with no debt, nice and clean, probably about 2 mil. So if our EV is 5.5 mil, clean shell, say 2 mil, the market's only giving a valuation of 3.5 mil to Krakatoa, and in that position, 35 k's north of that Cadia mine. So where you'll see that, we'll move on. So here's another perspective of where we are in relation to the others. If we start right up the top there, right up north there is Alkane's Boda discovery. And as you guys probably know, this Boda discovery is just getting bigger and bigger and larger. We're there in the middle, and then further south you'll see in the gold is Newcrest Cadia. Interestingly, we're right next to, just east of Copper Hill. Now, Copper Hill's not really been talked about much, but the beauty about Copper Hill is Copper Hill's got a known resources, and they've been published, of 500,000 tonnes of copper and 1.47 million ounces of gold. One of those drill intercepts was 60 metres at 5.4 grams a tonne gold and 1.83% copper. Now, in perspective, if we look at this Boda discovery that was announced in September 2009, fairly recently, that was 502 metres at 0.48 gold. Now, that interception, or that announcement of that intercept, added 200 million to their market cap. And if we compare them, we're right next to Copper Hill, right? So that's 60 metres at Copper Hill at 5.4 grams. That equals 324 grams. And that Boda discovery that put 200 mil onto their market cap amounts to be less, 241 grams. It's just thought that was relatively interesting. We're in the same geological belt as both the Boda discovery and Cadia. We got the same tertiary basalt cover that's masking most of it. We've got the same Audiovisian rocks, and we've got exactly the same geophysical signatures. We've just completed a scout drilling program, fairly shallow, and we're delighted by the outcome of that, as we have, in a nutshell, what this scout drilling program showed us was that the two main geophysical structures that we've previously highlighted and announced to the market are married up perfectly with now geochemical signatures. So we're getting closer and closer to, we're just ticking boxes to gearing up for some diamond drilling later. Interestingly, this is another, that was at Bell Valley, the target. That's at the very north of the project on the previous slide, where we're hell-bent on doing some diamond drilling. This slide here is another prospect on the same license, just south of there. We call this Sugarloaf. You can see a massive triangular shape, what appears to be a magnetic low there in the green, which is also on the right-hand slide. You'll see it, it's like a deformed donut. Previously, a rock chip of half a gram a tonne was was grabbed from that area. And then if we go to the next slide, we've just recently got some boots on the ground. We've just had some land access agreements done here. And this sample, we've just grabbed, we're highly encouraged by, because that's 5 grams a tonne of gold and nearly 2% copper. So that's, secondly, there was what we'd call pathfinding elements as well in there, being silver, lead, zinc, moly, and some antimony. So we'll be looking to explore that in far more detail shortly. And we have another project called Turon. The Turon project's not really a porphyry hunt. That's more like a reef system, potentially akin to, I guess, Kalamazoo. It's it's a stone's throw from where the world's biggest gold specimen was found, and which is still the biggest specimen to this day, the Halterman Nugget. And rock chip samples from around that area gleaned 1,500 grams a tonne, 150 grams a tonne, and about 60 grams a tonne. So that needs a bit more work, and we're keen to get into that, and we're keen to drill that as soon as we get an opportunity. So just in a nutshell, geology-wise, we're in the Fairbridge Volcanics, the Oakdale Formation. Again, host to Cadia Ridgeway, only 35 kilometres due south. And we've got that Boda discovery that's getting bigger and bigger, only 65 k's to the north. It's in a world-class location, Tier 1 mining jurisdiction of New South Wales, right in the middle of the Lachlan Fold Belt. And we've just done those 127 AC holes, depth approximately 18 metres, and that unearthed some geochemical enrichment zones that absolutely match the previous geochemical signatures. Next, we're planning to tick another box. We're going to do some deep ground penetrating radar. That's planned for next month, and hopefully we'll have enough evidence to be able to be confident to do some diamond holes later. Thank you very much.
Thank you very much for that, Colin. That was a great presentation, and you can always tell the quality of a presentation and the information provided by the number of questions, and clearly you've answered all the questions in your presentation, so thank you very much, Colin. A great presentation. And now we change gear a bit here and move away from resources. We've had a couple of resources presentations, but this next presentation is from Little Green Pharma, stock code LGP. And we're going to be hearing from Fleeta Solomon, the Managing Director of Little Green Pharma. So Fleeta, over to you.
Thank you, David. Thank you very much, Tim, for the invitation to be here, and good afternoon to all the viewers. It's an absolute pleasure to be presenting today, especially to those who might be new to the medicinal cannabis space. You're in for a real treat. It's such an exciting industry, and rarely in life do you come across a business that has such a great commercial opportunity, but also has a social impact. And by that, I mean changing the lives of patients and people around the world. Patient stories, patient feedback is real. And it's the reason why the team at Little Green Pharma get out of bed every single day. And it's such a dedicated and passionate team of individuals that it's the reason why we have achieved so many milestones in such a short amount of time. And this is the same team that's going to continue as we strive forward and achieve the next lot of milestones. So thank you for being here. So my name is Fleeta. I'm the Managing Director at Little Green Pharma, and we are Australia's first producer and exporter of medicinal cannabis. It's a vertically integrated business model. We cultivate, we produce, and we manufacture. We have existing sales and a very clear pathway to increasing margins as we drive our revenue growth, and we have a clear pathway to domestic and international sales. So if we have a look at why LGP, and in particular our highlights, in August 2018, Little Green Pharma made history, and we became the first company in Australia to produce locally grown cannabis medicines for patient use. So since then, we've been generating revenue month on month. So really a unique feat, considering it only took about 18 months for the business to get to the stage of generating revenue. We also made history recently when we became the first company to export Australian medicinal cannabis medicines to the United Kingdom. And so this was just a week or two ago, and we're looking forward, and we expect to export to Germany as well through our sales agreements that we have with a number of distribution partners within these jurisdictions. And in Germany, we have received a purchase order for 2,400 bottles, which we're looking to execute soon. And perhaps the reason why Little Green Pharma has this first mover advantage, and the reason why we had speed to market is because we partnered. We have an exclusive partnership with a manufacturer in Perth who already had GMP status, which is a certification at the highest level because it's compliant with the European guidelines of their standards for pharmaceutical medicines. Now, the reason why this word GMP, it's an abbreviation that anybody that's thinking of investing in medicinal cannabis space needs to understand. It is so integral to the longevity of a business. And this is because having this particular certification places Little Green Pharma in a really unique position. But the reason for this is we are just one of a handful of companies across the entire globe that actually have this. And that means that we're one of the few that can only export our medicines into the European Union. So I think this is a really important point, very unique to Little Green Pharma. We recently achieved a great milestone. We expanded our cultivation facility footprint to enable production up to 110,000 bottles per annum. And this is about a 10 times increase to our existing or our initial production capability. So we commissioned this in Q1 this year. We did this on time and on budget, which is fabulous. It's licensed, and we are just waiting for it to be permitted before we start planting out and putting our plants in. We're also constructing our own manufacturing facility, of which we have a license for. And the reason for doing this is just so we have greater control over our supply chain and to drive margins. But that's an exciting step that we're moving forward and currently underway. Perhaps another point of differentiation, and I guess this comes to longer term sustainability as a business, and that is that we're developing a unique drug delivery system. This is important because we need to be different from just the traditional oil medicines that perhaps is being launched across the globe at the moment. You know, we're here to solve real patient problems. And if that means that we can effectively provide a medicine, how it's delivered into the body so that it's a smaller and a more precise dose and still get the same efficacious response, then that's really ideal and where the company is striving. And we've also got to where we are today because we're a really lean business. And what I love is that, you know, we are generating revenue. And before we listed earlier this year, we already achieved that. We did a proof of concept on a smaller scale to enable us to open up those entire pipelines and pathways so that it was much easier for us to list and to raise the 10 million that we did in February. So we have a strong balance sheet with 6 million cash. If we look at the company overview, I'm going to be very brief on this one. It's basically, our strength is that we're vertically integrated medicinal cannabis business. We cultivate, we produce, and we manufacture. This allows us to control all aspects of the value chain. And therefore, when we look closely, we can determine where we're creating value, where perhaps value is being destroyed, and where we're able to indeed drive margins further. So we do have existing sales and a very clear pathway to increasing our margins and driving significant revenue growth not only here domestically in Australia, but also overseas. I'm going to skip this one, thanks, and just go straight to our track record of growing patient access. So since January, we've had a 26% compound monthly patient growth rate. So in total, we've had just over 3,000 patients who have used Little Green Pharma products in Australia. And in total, we've had just over 10,000 or nearly 10,500 bottles sold. So not a bad milestone considering, the company has only been in existence, just a few years. Moving on to our financial metrics, which are all on a positive growth trend. We, as mentioned, are generating revenue well and truly, and this is increasing month on month. So in the first half of financial year 2020, our revenue was 716,000, and this was up 188% from the 12 months to financial year 2019. This quarter, we've just put out our quarterly activities report, and our record, we've had a record quarterly sales of 4,029 bottles. So this is a 40% increase on our previous quarter. And this has delivered $630,000 in cash receipts. So our gross margin is 54%, which is up from 41%. Our patient numbers, as I've mentioned, it's above 3,000 now, continues to grow month on month. We have 240 unique medical practitioners who are prescribing. And of course, we're over that 10,000 number for bottles sold. Since listing earlier this year, we've made significant progress, and a couple of the points that I just wanted to talk about here, because perhaps this is a little bit new to some people. We've executed a couple more sales agreements into Germany and also into the UK. So further to the 2,400 bottle purchase order that we have to fulfill in Germany in the coming months, we also have signed another agreement with Demican, and this is for up to 1,000 kilograms of dried flower of medicinal cannabis, or equivalent in oil, which is about 48,000 units or bottles. So we're looking forward to fulfilling that. And we also have a 5-year sales agreement with Astral Health in the UK, who we recently did our first shipment for a patient just a couple of weeks ago. I mentioned that we have a new facility. It's an expanded facility of our original. This has been licensed. So the Federal Office of Drug Control have granted that license in addition to our own manufacturing that has been commissioned. It can produce up to 110,000 bottles. So we're just waiting on the permit for that. And I think this is a really good point or a time just to mention that we're not limited to 110,000 bottles, because we also have the ability to import, and we are importing raw material from other groups who also have amazing quality raw materials that we're able to manufacture. So we're not limited with this cultivation footprint, and we're also able to expand that footprint if necessary. So if we found that our cultivation was amazing and we needed to increase it, we can easily do so. It's just a matter of licensing and permitting from the Office of Drug Control. We also have significant partnerships, and there's one in particular I want to mention today because it's the reason this company started, and it's really the vision and where we're going, and that is our product development and our drug delivery systems and technology that we're actively working on to enhance the benefit for patients. So this is an exclusive partnership we have with Curtin University and the Arise technology, which we have the rights for in relation to medicinal cannabis. So essentially this is our precision dosing methodology, which makes the cannabis or the active ingredients more bioavailable for the human body. So it's just a more effective way of absorbing the cannabinoids at a much lower dose. And finally, with our product, yes, we did a first export, the first of many to come. So we're thrilled to pieces. That was a milestone moment, not only for little Green Pharma, but for the Australian medicinal cannabis industry. You know, it's what the Federal Health Minister, Greg Hunt, set out to achieve in January 2018 when he declared that export is available. So we were thrilled to do that. And we have now our 4th product offering in the market, which is a high CBD 50 medicinal cannabis product. And just to finish off, I'm going to skip the news flow that's available for you. And just to finish on the corporate structure, very simply, we've listed on the ASX on the 20th of February in 2020. So this year, 10 million we raised, oversubscribed. Company has no debt. We have shares outstanding of about 133.5 million. 11.6 million of those shares are escrowed for 6 to 12 months from listing. 54 million of those shares are escrowed 24 months from listing. Share price today is 28 cents. Market cap roughly 37 million, with an EV of 31 million, thereabouts. So look, given that I am over time, I'm sure, given our achievements to date and the fact that we are indeed leading the Australian medicinal cannabis industry, I feel that this is truly a hidden gem. And in fact, on the resource theme, green gold, which it's often fondly referred to. So I believe our achievements are so great and it's yet to be recognised by the market. So we're looking forward to that in time. Thank you very much for everyone's attention. More than happy to answer questions. In the interest of time, I guess that we'll do that online afterwards. But thank you and enjoy your day.
Thank you very much, Felita. There'd be a rousing round of applause from our attendees. So we'll have to give you a virtual round of applause. I did have one question that came through. You see some companies, both biotech or pharma companies, tend to try and start big and backfill. Was it a conscious decision to start leaner and smaller and grow as the business grew?
Yeah, and I really think this was a key to our first mover advantage and speed to market, because we, to this day, perhaps one of the fewer companies that have little overheads or little capex in comparison. So we decided to fit out just a very small portion of a large facility and prove to ourselves that we could grow, that we could manufacture, and that patients could benefit. And it was much easier back then when the demand was unknown, and it was easier to work with our Office of Drug Control. So there, for so many reasons, it was so much better to have this really lean business model, because to be able to generate revenue instead of being pre-revenue for listing was, in my opinion, one of the smartest things that we've ever done, because it decreases the risk with the company. So yeah, look, a really important point. And to this day, we've got no debt, and we've used little cash in comparison to many of the other groups perhaps that have extra large cultivation footprints and overheads. Certainly we were aiming to break even or to be profitable later this year. Yes, sure, COVID has hit and will challenge, but I think the industry is relatively recession resistant. So we're looking forward to, we've had no signs of patients not buying their medicines, but we'll see what happens over the coming months.
Felita, a great presentation. Thank you very much. As you've said, a company in revenue, growing and exporting. So a fantastic trifecta. Felita, thanks for your presentation.
Thank you.
We'll now move on to our last presenter, and who's come all the way from the US. I should have said our presenters have come from multiple jurisdictions to be here today, and Ted is no different. Ted is the CEO of Engage BDR, and I'll pass over to Ted now to give his presentation. And remember, if people do have questions, just use the Q&A function at the bottom and we'll get to those questions at the end. Ted, over to you.
Thanks, David. It's good to see you again. And we spent some time together a couple times, and I think in Sydney and Melbourne, I think a couple years ago. So good to see you. I'm Ted Danik. I'm the CEO and chairman of Engage BDR, EN1 on the ASX. We've been listed on the ASX for a couple of years. We're just coming off of an incredible year. 2019 was pivotal for the company. It was a profitable company, profitable year for us from an operating EBITDA standpoint. And we were on our way to we're about 300% of 2019 year to date. And then COVID hit, but we are doing much better than anticipated, or the industry is doing right now. So to give you some insight, we can start with the first slide. There's some disclaimers here. We can get past that. Essentially, we've developed a proprietary technology, which is artificial intelligence and machine learning, which automates and maximizes the transactions of digital video, native and display advertising and influencer marketing for advertisers, their agencies or their ad agencies, and app publishers who display these advertisements. So very specifically, we play in the mobile app space and also connected television, which is where all of the ad budgets are headed, probably in Australia soon, but here in the US, all of television has become digital now, and connected television is where you advertise there. So we are an ad company, essentially, specifically on apps. So we don't do websites. We don't market on websites and other content places like that. It's a $108 billion business today, 2020 in the US. US 108 billion. That's a global figure, about 70 billion in the US, and 10 billion in US for influencer marketing, global influencer marketing budgets, and we're in that space as well. And 28 billion international. And the space very specifically is called programmatic advertising. So that gives you a little bit more insight. We can go to the next slide now. These are our brands. Engage BDR. We've been around for 12 years, so people have, we're pretty popular. We've been some of the founders of the company, myself, board member Tom Anderson. Tom Anderson was the founder of social media and in MySpace, and I was on the executive team as well in MySpace. So we've been in the industry for a long time. Iconic Reach is an influencer platform, our influencer marketplace, which was designed by Tom Anderson, the founder of social media, or MySpace as well. And AdSell, a company that we bought in 2018, which is a great successful acquisition. We can get to the next one now as well. And essentially all of our business is fully automated. So we have about 100 billion transactions per day, or auctions per day, and it's all automated. So we don't have salespeople. We have 0 sales staff. We have a very small team of 17 people, and 17 full-time employees. They're based here in West Hollywood, California. And so we're pretty optimized. Everything is machine learning, AI, and fully automated. Next slide, please. So this is our footprint, a little bit of our key facts as well. We're in LA, we have an office there. We have an office in Kyiv. When we bought AdSell, we inherited their operation as well. And in Melbourne, we have directors that are based there. So we raised 0 outside capital until the IPO, which is in 2017. We did a couple $100 million, about 250 million in revenue before the IPO. We're profitable most of those years. Key fact, last year we did 17 million in revenue, 1.6 million EBITDA profit, and some other information here, which might be interesting to people. 11 years, it's our 12th year. Some information on the capital structure. Current price is 1.2 cents. We got hit pretty hard with all this people freaking out about, the world going away. And so we got sold into a little bit, but it's a good time to buy, I would say. 890 million, good time to buy in general. I can't say our stock, but I would just say in general. 890 million shares on issue, 11 million market cap. Founders own about 22% of the company, about 200 million shares roughly. The top 20 is about 52% of the register. There's about 2,000 plus shareholders on the register at any time. This is our timeline, and all this information will be available later. I intentionally added a lot of extra slides on here just so people can have some background. As I mentioned, the company was founded in 2009, and there's a lot of evolution for the company here talk a little bit about some of the acquisitions and our return to profitability last year, our IPO, the shifts from display advertising to video advertising, from non-programmatic to programmatic, et cetera. Next slide, please. So this is basically programmatic advertising. It's an automated process of online advertising inventory through auctions, which we call programmatic advertising. These buyers are integrated through server-to-server connections. It's very technical. Each integration takes about 3 months to do. We have about 220 programmatic integrations, some of the biggest buyers in the world, as far as buying platforms, or what we call trading desks, who are integrated. So essentially how it works is people use an app, a game, or utility, and they load the content. On that page, you'll see ads. Bids are placed for those ads by those buyers. Somebody wins the ad based on their bid price, and then a relevant ad is shown to the user. So all of this happens in 200 milliseconds. And so just to give you an idea, all of digital advertising in the US is programmatic advertising. It's not a new thing anymore. Became pretty big starting 2016, but all of it now, including your billboards, taxi tops, connected television, and mobile and desktop as well. Next, please. Advertising inventory, and this is what some of it looks like. As I mentioned, connected TV ads on the left. And I don't know if you guys have Roku over there, but we have Roku and other set-top boxes and streaming media. Well, there's apps on those boxes, and those apps will include content and ads on those to monetize essentially that content. And so those are the highest CPMs right now and the highest growth areas of all advertising in the US currently. Display advertising, which you've probably seen in the middle, influencer marketing, where you have some younger people, 20-plus-year-old kids making $10 million a year on YouTube. Well, those are influencer marketing superstars, and we work with thousands of them. Video ads as well. That's our bread and butter. That's what we mostly do. So when you're on YouTube watching a piece of content, you'll see that there's an ad and a commercial, which you hate. We're responsible for a lot of that. Next, please. So our goal is, what are we trying to do? We're trying to be one of the largest programmatic platforms in Asia, or Asia Pacific. That's why we listed on the ASX. We felt that Asia Pacific strategy makes a lot of sense operating from Australia. So that's the goal. That's the reason why we came to Australia in the first place. There's a lot of great talent there that has a lot of experience with Asia Pacific, and so that's our goal. I think it's a really good opportunity and time to grow pretty quickly in Asia through organic growth, but also through acquisition. We do a lot of business in Asia currently as well. Next, please. Some of our highlights on the financial side, the assets and liabilities. So we had some pretty great contrast last year. Some highlights here. Yeah, there we go. Okay, so we have about 17 million in total assets on the balance sheet. Total liabilities are down to 13 million. Net assets are about 4 million currently. Next slide, please. Revenue, as I mentioned, was 17 million last year, which was 50% growth over the previous year. 11 million the previous year. The OpEx was about 7 million, significantly low. The gross margin was 54%. We operated a 54% margin in 2019. The EBITDA for 2019 was 1.6 million profit, or operating profit. Next, please. This year, some interim results. We were about 303% year to date of 2019 as of end of February. March was doing really well as well. We put out those numbers. We're one of the only companies in the world that puts out our results every 2 weeks. I don't know anyone that does. You could show me a company that does and I'll be excited. But we do this to keep ourselves accountable. So we communicate with the market so the market knows exactly what's going on with us. If you look back for the last couple of years, you'll see announcements from us frequently about our revenue and about what's going on with the business. So about roughly every 2 weeks, or we have a mid-month, and we have a monthly recap of how the revenue was for the month. And it's enabled us to be pretty accountable, and people give us a lot of great feedback saying that, hey, you guys have done You guys are really communicating well, and no one else communicates like this. So for us, we do this because we want to gain credibility and accountability, and keeps us accountable to our shareholders as well, who are our bosses. So this year has been pretty good so far. Some comparables to give you an idea. The Trade Desk is a NASDAQ company. They do exactly what we do. They have a $14 billion market cap. They're trading at 24 times revenue, 140 times EBITDA. AdSlot is a company on the ASX. It's an Australian company. Their market cap's about 45 million right now. They're trading at 5 times revenue or so. Our market cap's 11 million. We're trading at 0.6 times revenue. So as you can see, it's pretty lean. There's a lot of room there as far as from a valuation perspective. And our EBITDA, we're trading at 6.8 times EBITDA. So you can see and we're profitable, and many of these other companies are not. So that gives you a little bit of insight as well. The board, as I mentioned, I'm ex-MySpace, one of the original people that was a part of the business when it launched. From inception, I was also part of a company called LowerMyBills.com, which we sold to Experian for nearly $500 million USD. I started my career in the mid-90s in Silicon Valley, so I've had a lot of experience, and I'm pretty old. Board is comprised of very experienced people. Tom Anderson, as I mentioned, arguably the founder of social media, also the founder of MySpace, who I worked very closely with for now 17 years. Rob Antelov, he is on our board and very experienced in the M&A space and corporate development. He's based in Sydney. And Darren Pism as well. He's our non-exec director in Sydney. He's a very smart guy. And thank you so much. Feel free to reach out to me, Ted, at en1.com. If you have any questions, I'd be happy to answer, as long as they're not sensitive and they don't send me to jail.
Ted, a great presentation, and thank you for getting up early to give this presentation, or staying up late, whichever it was. Clearly a business that's playing in the right space in a market that is growing, and getting a big market that's getting bigger and bigger, this programmatic ad market. A great presentation. There are no questions, so I can let you off the hook. I have one question for you. In the space that you're in, how active is M&A? And do you think you will be a company that will play actively in that space as someone looking to make acquisitions?
I think that's a great idea. We're looking for deals all the time. And I think that, everyone's been impacted in our space somewhat, or a certain extent. I mean, companies that we've had conversations with on the average have been impacted 70% here in the US from a revenue perspective. Based on our recent announcements, we're roughly between 30 and 40% impact in March. And so, April's looking better. And because of that, we think that there's going to be cash crunches for private companies, and there'll be opportunities for us to buy. Now, I think that from our perspective, what's really important to us is we need to make sure that our market cap and our assets and our balance sheet can support any of these types of deals. What we find is that there may be opportunities for companies to continue operating through acquisition rather than looking for an exit and see an exit another day in the future. From our perspective, we want to prevent dilution. So we got to be really careful about how we do these deals. We really don't want to issue a bunch of shares because we think our share price is extremely low right now. It's the lowest it's ever been right now. And I think that, that's advantageous from the perspective of like the fund that we just heard from in the beginning, the first presentation. They're looking for deals like this, right? And so I think, but from our perspective, we don't want to issue shares to buy something, and we don't want to issue the cash because we need the cash to grow. So it's a little scary, from that perspective. But the debt out there is really cheap. So we're looking at debt, and we've applied for some straight debt opportunity with Australian banks. And so we're looking, for responses to that soon. If we could raise enough money through debt, then I think it could be a viable solution to make acquisitions. But I think that would be 60 days down the road when we start really seeing people feeling some pain, I think.
There's a question, or a couple of questions have come in relation to AdSlot and how you compare or not to AdSlot.
Sure, that's an easy one. So AdSlot is, they play in a, I like these guys, but I'm not, They're a totally different business. They're a programmatic ad company, but they're not in the same space. Now they're on the demand side, so they license a piece of software to agencies, very specifically to agencies. So they're a SaaS solution, and that they're making some money on media as a commission or something like that for media traded on their platforms. But the only type of media that they're trading is called guaranteed premium. So it's on a flat rate CPM, and it's not an auction-based system. Now, 99.9% of all media traded in the US is on an auction-based system. It's real-time bidding, open RTB. So we picked the biggest dartboard to throw the dart at, and that's the one. Now, there's a smaller dartboard to throw a dart at, and you want to be niche, and I think it's going to take a longer time to grow. So they're on the demand side, meaning they work with the agencies and the brands. We're on the supply side, so we work with thousands of publishers direct. So that's the difference between our businesses. We own all of our technology. 100% of it is proprietary. There are probably billions of lines of code. It's developed over 12 years. Auctioning systems, as I mentioned, we host 100 billion auctions a day. There are very few companies that do that. We're up to about 1.5 million auctions per second at our peak. So it's very, very difficult technology, and you got to hold those auctions for 200 milliseconds to be able to, conclude those, to serve an ad and conclude an auction. So from that perspective, from a technology standpoint, I could say that nobody that's been mentioned in this conversation has technology that's robust like that, except for us.
And in terms of ad blockers, do they affect your business at all? Absolutely
not. Ad blockers are something to worry about on the web. We're all app. You can't block ads on apps. And also, it's negligible. It doesn't impact our business at all. We don't even notice it. And the reality of it is those users you don't want anyways, because they're users that are pirating your content for free. It's essentially pirating, right? It's kind of like when people were downloading MP3s on Napster for free. They didn't want to pay for the music, right? Well, this is the same thing. They don't want to pay for the content, so they're using ad blockers. But no, it doesn't affect us. The SDK on the app, on the device itself, circumvents anything else that they could put on the app to block any ads. So it doesn't impact app traffic. And you can't put an ad blocker on your connected television. And that's what we really care about, is connected television. So no, it doesn't impact us. We're not on the web. We don't do anything on websites. We don't want to play in that world. The CPMs are too low. Our CPMs are 10 times greater than that, at least. So you want really robust targeting capabilities. It's app users. You get latitude, longitude. You get so much more behavioral data on the user. It's rich. On the web, you get none of that. You get an IP address on the web, and you know what? You might be in Sydney, but it says you're in Egypt. Literally, those IP addresses are useless. So we don't really want the web. We don't care. We left the web in 2017. It's from our perspective, it's the smaller opportunity.
Well, as a founder of MySpace, clearly a visionary in the technology space, and with the Engage BDR achieving significant success and more to come, no doubt. So Ted, thanks for a great presentation.
I appreciate your time, David. Thank you so much.
Okay, well, that brings us to the conclusion of our ShareCafe webinar today. I'm sorry about the minor hiccup in the beginning where we lost our MC, so I've had to step in and to assist. But what I would recommend is to all attendees and those watching is head on over to ShareCafe to find out more about each of the companies who presented, but also to get a greater understanding and insight into a range of stocks from micro to the large stocks on the ASX, and get some insights into what's happening in share market land. So on that note, I'd like to thank everyone for presenting. I'd like to thank everyone for attending, and wish you all a great day. Thank you very much.